Have you ever pondered the true power of a share? Imagine owning a piece of a company, a slice of its future, and a stake in its success. But not all shares are created equal. Today we dive into the world of ordinary and preferred shares, unraveling their mysteries and uses. Ordinary shares, also known as common shares, represent equity ownership in a company. They grant investors voting rights, usually one vote per share. This allows shareholders to weigh in on company decisions at annual general meetings. The dividends of ordinary shares are variable and depend on the company's profitability. Thus, if the company thrives, so does the potential dividend. On the flip side, preferred shares offer a different flavor of ownership. These shares typically do not provide voting rights, which might seem like a disadvantage at first. However, they compensate with fixed dividends, making them a more stable income source compared to the often fluctuating dividends of ordinary shares. Preferred shareholders also enjoy a higher claim on assets and earnings. In the event of a company liquidation, preferred shareholders get paid before ordinary shareholders, but after debt holders. The dividend payment structure starkly differentiates the two. Ordinary shares' dividends are not guaranteed. They can be high, low, or non-existent, based on the company's performance and decisions by the board. Preferred shares, however, promise a fixed dividend, making them akin to bonds. This makes preferred shares particularly attractive for risk-averse investors who prefer predictable returns. Moreover, the potential for capital gains differs significantly. Ordinary shares are generally purchased for their growth potential. Their market value can soar as the company grows. Preferred shares, while more stable, typically offer less in terms of capital appreciation because their price doesn't fluctuate as widely as that of ordinary shares. Now, who typically invests in each type of share? Ordinary shares attract investors who are looking for growth and are willing to accept more risk for potentially higher returns. They are engaging in the journey of the company with all its ups and downs. Preferred shares, conversely, are often favored by those seeking steady income, like retirees or those who prioritize a lower risk investment. In summary, ordinary shares and preferred shares cater to different investor needs. Ordinary shares offer a ride on the company's growth with voting rights and variable dividends, but come with higher risk and volatility. Preferred shares, meanwhile, provide fewer rights but offer greater security and steady dividends. Each type serves a unique purpose in the investment landscape, tailored to different risk tolerances and financial goals. So, whether you're a thrill seeker or a safety seeker in the stock market, understanding these differences can guide you to make informed decisions that align with your investment strategy.